Young of the Asian Bureau of Finance and Economic Research and NUS Business School, together with my co-organizer, Professor Zhiguo, Fuji Bank and Hiller Professor in Finance of the U of Chicago booth and also the BFI China, as well our collaborators, Professor Peng Jun of SAIF in Shanghai, Professor Michael Zhong of CUHK, Hong Kong, Professor Xiaoyan Zhang of Tsinghua PBC School of Finance, and Professor Bohui Zhang of CUHK Shenzhen. We would like to welcome you to the inaugural session of the seminar series, Capital Market Development, China and Asia. Asia has grown a lot. The team, the members I just mentioned, we discussed this. We recognize that behind this phenomenal growth is great development in Asia's capital markets, especially China. The development is often very subtle, but has a very high impact, which may have escaped the attention of academics, policymakers, and even practitioners. And yet we also recognize that the development is still work in progress. So we decided that we will launch this e-seminar series. Our belief is that in-depth research allows us to see where the development is at, allow us to see the impacts and the stress points. And also the seminar will allow us to learn from experience across countries. And also we hope to stimulate further research that will produce work that informs policymakers, practitioners, and fellow academics. We thank the audience for your support and also the presenters and the discussions in this series. Today, our inaugural speaker is Professor YEUNG. He is Hugh Lander and Mary Trumbull-Adams Professor in Finance and Professor of Economics in the Department of Economics and Bendheim Center for Finance, Princeton University. Song Wei's research interest centers on capital market imperfections, behavioral finance, and China's financial markets. He received the prestigious 2012 Smith-Breeden Award First Prize for the best non-corporate finance paper published in our top journal, the Journal of Finance. His recent work include the very important high-impact edited volume Handbook of China's Financial System, together with Dr. Malene Amstad and Dr. Gaofei Song, and that book is just published November 2020 by the Princeton University. Song Wei is so influential and has done so much work that really further introduction would be wasting your time to listen to him. So we are going to turn to Professor Song Wei, who will talk about the overview of China's financial system and current challenge. And this inaugural seminar today is going to be a bit different from later seminars. There will be no discussions. Professor Song Wei, the floor is yours for 40 minutes, and we'll do our best to collate the comments and questions, and we'll have 20 minutes for Q&A afterwards. So Professor Song Wei, please.
Thanks, Bernard, Zhiguo, and June for inviting me to give this inaugural seminar in this wonderful seminar series. I thought it's a great idea and it's much needed for the region. So today I'm going to sort of use this opportunity to give an overview. In fact, this is a topic assigned by Bernard. so I'm going to use this to summarize actually a new handbook I just edited, as well as talk about some of sort of related topics about China's financial system. I think this topic is an issue so that everyone, I suppose, in the room are familiar with. China's financial system is quickly growing, and it's still, at the same time, still under tremendous reform. A lot of discussion over the recent years about this system. Besides, it's already second largest in the world. At the same time, several important reforms are still on the way. Interest rate liberalization, IPO reform in the stock market, RMB internationalization and the capital account liberalization and so on. So very exciting and very dynamic. At the same time, I think sort of across the world, there's also increasing attention on what eventually going to happen to this system and how this system going to, will crash with the world. And in fact, actually, given sort of the ongoing geopolitical tension between US and China, at some point last year, we were even sort of talking about the potential decoupling of China's financial system from the rest of the world. So there are all these very important and potentially controversial issues around China's financial system. So I thought today I will sort of first give sort of a general overview about the system itself. But there's so many things we can talk about. I want to sort of at the end use this session to focus on one particular issue about China's financial system. It's about this peculiar feature. So after 40 years of successful market reforms, right? Many people, especially people outside China, thought, or at least expected China to eventually converge to a system that just looked like the system in a Western country, right? I think sort of it becomes more and more clear. So that's not necessarily the end point, right? So the end point is not a sort of a laissez-faire kind of a system we see in a typical Western country like US. In fact, actually, China's system is sharply different in the aspect that it combines both markets together with very strong government interventions. So in that sense, sort of there's this very important structural difference between China's financial system and the rest of and sort of what we typically see in a Western country. I think sort of this difference is not necessarily sort of feature because of China's ongoing reform, right? It's indeed sort of lots of reform are still underway, but at the same time, sort of I think so it's important to for us to recognize sort of this important difference, because this structural difference imply very different market dynamics, which I will discuss a little bit later, sort of in terms of thinking about sort of various issues in China's financial system, like the real estate boom, like the rising leverage and so on. So for that reason, sort of it's important that we at some point recognize and potentially sort of develop a different conceptual framework to think about China's financial system. So here's a quick outline. As I said, I will give a quick overview of the system itself. Then I will shift to talking about the fundamental difference. So this is a good time actually for me to talk about this overview about the China financial system, because I just edited the Handbook of China's financial system together with Guofeng Sun and Martin Amstead. 5 years ago, Daryl Duffy, who is the next speaker next month, told me that he started to teach a course on China's financial system at the Stanford University. I was shocked initially, realized sort of if he can do it, I should do it too. So I started. In fact, actually, Zhiguo also started it shortly after that. So all of us have been teaching a course on China's financial system in various universities around. But at the same time, during our teaching, we realized actually it would be really nice to have some reading materials for the students. So in some sense, the handbook is much needed. So that's how sort of I started to think about this handbook. It happens, Guofeng Sun, my co-editor, who is currently director of PDC's Monetary Policy Division, was a visiting scholar at the Princeton at that time. And he co-taught the course with me our first semester. So during this, we started thinking about getting serious about editing this book. And then Martin Amstead, who is a professor at the CUHK Shenzhen until last month, she just started as the chair of Switzerland's FINMA, I need to spell the full name, Swiss Financial Market Supervisory Authority a couple of weeks ago. We invited a bunch of scholars and experts in policy and academia to put together this handbook. It took almost 3 years, and finally it came out a couple of months ago by Princeton University Press. Due to the time, I won't be able sort of to go through every chapter here, but I thought the handbook actually provides a very nice coverage of all the sectors of in China's financial system. I would just quickly sort of give a bit of an overview here in junction with sort of thinking about the unique features of China's financial system. Daryl Duffy nicely provided a forward for the handbook, given that he really stimulated to think about the sort of thinking hard about the China's financial system. The handbook has 17 chapters spanning 6 different segments of the system. The banking system is still the core of China's financial system. By 2018, the banking institutions contributed to 76% of aggregate financing to the real economy. It actually also owns even greater fraction, 97% of total assets in China's financial system. This is because banks not only make loans, but also are the main source of funding to the bond market and many shadow banking products like trust loans and interesting loans and so on. The 4 state banks initially spun off from People's Bank of China as a commercial lending division back in the 80s, represent about half of the banking system. They inherited a large basis of depositors, and after decades of reforms, they are now among the top 10 banks by asset size, by profit, by capitalization in the world. By that regard, the China's banking system is pretty impressive already by size. It's particularly important to recognize that the banking system is important and played a hugely important role during China's economic reform. It shouldered the heavy burden of supporting China's state-owned enterprises, especially during the early years when those SOEs were not doing great and actually were losing tons of money early on. In fact, the reform process of China's banking system is also the process of reforming China's SOEs. Because of many of you know, China implemented this dual-track reform system. Instead of getting rid of all these money-losing state firms from the beginning, it started 2 tracks. While allowing private sectors to operate and flourish, at the same time, the government actually committed heavily to supporting the state firms in order to maintain social stability. And during sort of only after several decades of reforms, eventually the non-performing SOEs are now closed down. And eventually, we are actually seeing many SOEs are highly profitable and actually taking on very important roles in the Chinese economy. So in that sense, sort of the banking system really played a very, very important role during this process. To the extent that China still sets paramount priority to social stability and financial stability. So the banking system continued to play a very, very important role in supporting this policy priority. So the banking system also provided the sort of the main channel for China's monetary policy. In fact, in this part, the handbook covered the 4 different chapters covering the banking institution regulation. This is a chapter written by Guo Fengsun, my co-editor. And also 3 other chapters discussing various aspects of monetary policy. The second chapter here, co-authored by Yiping Huang, a well-known expert inside China on China's monetary policy, who is also an ex-member of China's Monetary Policy Committee, together with 2 co-authors. So they provided a very nice account of the evolutionary process of China's monetary policy. It reflects the overall economic background from a centrally planned economy to a market economy. So that some of you know very well, China's monetary policy still follows a so-called quantitative monetary policy system. Instead of targeting certain interest rate, like a typical Western countries, it targets M2 growth and the growth of aggregate financing to the real economy. So these quantitative measures of lending, basically. So the fact that PBC follows this kind of a quantitative monetary system reflects the challenges it faces in using prices and the interest rate to effectively influence a large fraction of the economy, which include SOEs as well as local government, which are not particularly price sensitive, right? So in that sense, sort of the reform ahead prevents China immediately adopt sort of perhaps more powerful and more effective sort of price-based system. People's Bank of China also has a large set of monetary policy instruments, ranging from standard market operation tools and all sorts of lending facilities created after the 2008 crisis. And even more impressively, the more powerful tools like macroprudential policy framework, which is the envy of all the central banks around the world. So we also have a chapter here written by Tao Wang, a well-known chief economist of UBS in Hong Kong, covering sort of all these policy instruments. So there are also a full set of interest rates in China. Many of them are already liberated and fully driven by market forces. However, 2 key interest rates, like bank deposit rates and bank lending rates, are yet to be fully driven by market forces, even though PBC has made great effort during last decade to liberalize interest rate. The 4th chapter here, written by Jun Ma and the co-author, Jun Ma was the chief economist of BBC, provided his account of China's effort to liberalize interest rate. And of course, the bond market, China already has a very vibrant bond market, as developed through China's interbank market as a key part of the interest rate liberalization process. So this is a chapter covered by my co-editor, Marlene Armstead, as well as Zhiguo, the co-organizer for this seminar series. They provide their account of this vibrant and quickly growing market segment of in China. In particular, I want to highlight 2 features about China's bond market. On one side, there have been very few defaults, despite the huge size. It's already 2nd largest bond market in the world, and as well as very high credit ratings. In some sense, sort of the very few observed default perhaps reflect the government's commitment to social stability and financial stability. So the government has been very reluctant to see large-scale default, which sort of, in a sense, this also reflected in the bond market here so far. Of course, we are seeing sort of a default eventually going up, but how much it will go up is yet to be seen. And The third part of the handbook covers the connection between financial system and the real economy. While China has long abandoned the so-called credit plan, the government continues to use far-reaching financial policies way beyond the typical monetary policy used by developed countries to support the real economy. Two economists from Emory University and Federal Reserve Bank of Atlanta, Kaiji and Taozha, covered this important part of China's financial system. The Chinese government often combines fiscal and monetary policies to implement a particular government policy agenda, such as the stimulus, the grand post-crisis stimulus in 2008, as well as various industrial policy designed to support various industries, and regional development plan like developing the western region of the country. So the financial system, especially the banking system, has provided a powerful tool to support these this set of broad financial policies. The real estate sector is another really important part of China's financial system. This is covered by a chapter written by myself and former postdoc Chen Liu. So real estate asset is the most important asset in Chinese households' balance sheet, even bigger than bank deposit. It is also key to the physical budget of local governments, which heavily rely on land sales to finance local investments. This is a model that actually mainland China followed from Hong Kong, right? So Hong Kong's real estate model. So this model makes real estate market heavily and delicately connected to all sorts of government policies. And it's perhaps not too stark to say real estate is too important to fail, just like the banking system itself, right? Perhaps for this reason, Chinese households are very enthusiastic about purchasing homes, including many investment homes. So real estate investment is also by far the best performing asset in China during the last 2 decades, better than stock market bond as well as bank deposit. Perhaps for this reason, many even calling the possibility of a housing bubble in China, right? So, and all this sort of to the extent is connected, related to government policy. This actually, in some ways, encouraged people to buy home. I think this is a very important aspect to think about the real estate in China. China is also known for heavy and successful infrastructure investment, which is often regarded as one of the 3 pillars of the Chinese economy, together with real estate and export. So the banking system, again, is the main source of for financing and funding for infrastructure investment across the country. So we also have a chapter written by 2 chief economists from Deutsche Bank to cover this very important aspect. In terms of ongoing reforms, RMB internationalization and capital account liberalization are 2 very, very important fronts. So the handbook also provides 2 chapters written by policymakers from PBC as well as China State Administration of Foreign Exchange to cover these 2 important reform process. China has made a great effort in opening up its capital markets. So, and in fact, it has successfully enlisted RMB into IMF's SDR reserve currency basket with a weight of 11%, only after US dollar and the euro, and even ahead of Japanese yen and the British pound. So this sort of has been a landmark for RMB's internationalization process. However, despite all this effort, RMB is still not used as much as the policymaker in China would like. As of now, for trade settlement, as well as global payment and the foreign reserve, by all these different measures, RMB contributed to about 20% of global volume, right? Across all of these measures, pretty much similarly 2%. So clearly, sort of this reflects challenges China still face in making RMB to be more used around. Part of this is about because of the restrictions on capital flow, right? In fact, actually, to help RMB internationalization, China has made also great effort to liberate capital flows. However, faced by a large setback in 2015 to 2016. Some of you probably remember China has a large capital outflow of over $1 trillion in a very short period of time. So the timing was not ideal at that time because while China was trying to liberalize capital flow, it's also the time when U.S. Was in the process of tightening its monetary policy by raising dollar interest rate, which made the dollar assets much more attractive. So perhaps current sort of the geopolitical environment, especially the COVID, the pandemic, which led to low growth across the world and central bank across the world cutting interest rate. The rapid economic rebound in China makes Chinese asset actually much more appealing than back in 2015, 2016 now. So perhaps this is actually a better time for China to further liberalize its capital flow. So these are all very important processes. In fact, this is sort of a very important sort of process, especially for global investors thinking about actually further into investing into China. China also has a very lively and dynamic stock market, which is covered in the 5th part of the handbook. We have 3 chapters covering different aspects of the stock market. Franklin Allen, a professor at Imperial College London, and Jun Chen from Fudan University, together with 2 other co-authors, provide a very nice account of China's overall stock market. They particularly highlight sort of the IPO process, which is sort of the central point for further reform at the moment. The mechanical IPO process might have led to the underperformance of the China stock market, which clearly lagged behind China's spectacular economic growth. Chong Wang, a professor from CUHK Shenzhen, provided a chapter to systematically discuss corporate governance reform in China, which is also a key part of China's SOE reform, as most publicly listed firms, especially in the early years, are SOEs. Tian Yuzhang, a professor from CUHK, provided a chapter to discuss the accounting system, which is also a key issue that concerns China's stock market. Some of you probably noted that last year, the accounting fraud of Luckin Coffee during its IPO in the US stock market has stirred up a huge concern across the world about this particular issue. And in fact, actually, during the tension between US and China, so this eventually actually triggered the process of delisting Chinese firm from the US stock market. Now with Trump administration leaving office and the Biden administration coming in, we're yet to see how this is going to develop into. But nevertheless, the accounting system is also an important aspect, deserve a lot of understanding about the China's stock market. Asset management is another part going through a rapid growth in China. Zhiguo, a professor from CHK, provided a chapter to discuss this very important aspect. Interestingly, despite China having still a retail investor-driven market, this chapter summarized that mutual funds in China actually perform better in terms of their, a mutual fund in China charge higher fees, but nevertheless, their net return after fee actually do not appear to underperform the market, which is very different from US. Some of you know very well, in the US, actually, mutual funds tend to underperform the market. The VC industry also had a tremendous growth in China. So it now has the second largest industry in the world. Despite the early years, this sector is primarily driven by international VCs. Now, in the recent 2 decades, the growth actually is mostly driven by domestic VCs. And this part is going to carry China into the next innovation-driven economy. And of course, China also the financial system also play a very important role in supporting the pension system. With the aging of Chinese population, reforming and improving the pension system is utmost important. Hamin Fang from University of Pennsylvania and Jin Fan from Fudan University provided a chapter to summarize this important aspect of the pension system. This part actually deeply connects to various challenges from efficiency cost of China's fragmented social insurance system, physical implications from potential growth slowdown, optimizing investment products and the impact on the labor market and so on. And lastly, China actually has also the most quickly growing fintech industry in the world. Microfinance model popularized by Yunus and Grimy Bank earned sort of a Nobel Peace Prize because of its potential to solve the financing of the poor, right? But actually, academia still struggle to find robust evidence for its success. But it appears big data and digital technology offered a far more promising model. And in fact, different firms in China like Ant Group and WeBank provide actually a great example to using this technology to provide financing to small firms and low-income households. This important aspect is covered by the last chapter, FinTech Development of Guo Huizang, a professor from CHK Center. So, so from all this, sort of, let me quickly summarize sort of the progress from the chapter China's financial system has made during the last 40 years. In fact, this is already, as you can see, a highly developed system. In many ways, you see sort of the usual, many of the usual, it follows sort of a familiar Western style structure, right, with many familiar features. But nevertheless, I want to highlight actually there's a very important difference from the typical Western system, right? So, you see sort of various restriction and control remain. To some extent, these are sort of such as IPO, like interest rates, like capital flow. So this restriction probably will eventually disappear, or at least largely mitigated as reform deepens. But some other restrictions that actually will remain, right? So because some are structural. So this sort of leads me to sort of highlight this important thing. To think about the structure of China's financial system, we have to connect this with China's economic model. The government, the Chinese government actually has been made this clear in many different occasions, right? So the model is about the combining enabling state, 有为政府, together with 有效市场, I kind of tend to translate this as effective markets, not necessarily efficient markets, because with all this restriction in place, it's hard to be efficient in the usual sense of no arbitrage in the financial market, but rather sort of effective in the sense of providing the necessary financing to support the economy. So, so in that sense, sort of as I mentioned at the very beginning, when I think about China's financial system reform, the final goal perhaps is not a laissez-faire system, but rather sort of this is a system where having a delicate balance between two powerful forces, right? Government intervention and market forces. So this is sort of an important feature, this means we will see, in fact, we have seen important persistent influence by the government, by the state on the financial system, right? As reflected in intensive government interventions and also important mandates imposed by government on the system to support government's policy agenda. So it's very important to keep this in mind. To make this concrete, perhaps I want to use this connect to sort of various issues we think about the concern about China's financial system, right? So a couple of years ago, I wrote a review piece with Michael Song, another co-organizers of this series on risk in China's financial system. Here is, we talked about rising leverage across China. On the left panel here, you see, so this is the aggregate debt in China divided by GDP. Before 2008, this ratio is very stable, around 1.2. After 2008, because of the stimulus, the leverage has been rising, right, to around 1.6 as a result of stimulus. Perhaps not surprising, but even after stimulus, leverage continued to rise. It passed to 2, and it passed even further, despite stimulus winding down. And in fact, many noticed that a big chunk of the leverage rising actually came through the shadow banking system. In some sense, this reflects sort of what we see in many other countries, right? When leverage rising, at some point, actually you see a crisis. And even more concerning, we also see a rapid housing boom across the country. So here's a chart taken from my own chapter about China's real estate market in the Handbook. You can see sort of very rapid, this is a national housing index, a very spectacular housing price appreciation across the whole country, much greater than what we have seen during the US housing bubble. So this combination of rising leverage and rising housing prices across country, in fact, actually concerned many people around, right? So are we going to see what happened in the US back in 2008, right? So this is sort of an issue, right? So are we going to see a financial crisis in China, right? So on this important issue, I think really to think about this, I think so that it's important to recognize the unique feature of China's financial system. In the Western system, financial crises are like pandemics. So given that we are still in the middle of pandemics, I think sort of we understand why pandemics are difficult for Western countries to deal with, right? So when the government actually even hesitate to require mandatory face mask wearing, so that's sort of the problem, right? So in some sense, sort of during the booms in the financial system, we have sort of similar difficulty faced by various countries around, right? During booms, institutions compete to take on leverage, ignoring the externality on the system. During the bust, each run for the door, right? So exacerbating the fall. In a sense, each again ignore their own running sort of on the system. So it's very difficult for a laissez-faire system to handle this kind of externality because the government often lack the authority to impose sort of a restriction either on taking on leverage or on stopping an institution from running for the door, right? So it's a very different sort of institutional foundation or environment in China, right? So I want to highlight this. The rising leverage, as I mentioned earlier, is actually directly related to state policy, right? either intentionally or unintentionally, during sort of the stimulus. In fact, actually, I should mention, the leverage actually is directly related to monetary policy, right? Because China has this quantity-based monetary policy. In fact, actually, monetary target is M2, right? Which is directly related to leverage in the country. So in that sense, so the rising leverage is one way or the other actually a direct outcome of the monetary policy. So given that, it would be sort of really surprising if the central bank target certain money growth, and then the large growth of the money eventually lead to sort of a financial crisis, right? So this is very different from sort of what we observe in other countries. Since 2008, a wave of academic study, starting with Rangoff and Reinhard Rogoff, as well as Schlag, Taylor, Amir Suen, and so on, showing that large credit expansion at country level eventually going to predict the financial crisis, right? I have also done some work on this front, using using credit expansion at country level to predict the stock market crash, and so on. So this is a very different nature in China, right? To the extent that the credit expansion itself is directly related to government policy, right? So this is not because of sort of different institutions in the system actually competing to take more leverage, ignoring sort of the externality on the system, right? So in that sense, sort of I think sort of we have to view the leverage in a different way, and also. We have to recognize most of the debt actually was from state bank to state firms and the local government, right? Through either the formal banking system or the shadow banking system. In fact, actually, Zhiguo has written a very nice paper early on highlighting this aspect, right? During the stimulus, is really sort of the lending to local government eventually sort of had started this credit expansion, right? So this nature all made sort of the nature of this leverage very different. And as I mentioned earlier, housing boom itself is also directly related to local governments. So with all of this, so the risk behind the credit boom as well as the housing boom is very different. And the government interventions and the guarantees, given sort of the paramount priority assigned by government to social stability and the financial stability. So the government has never really hesitated to intervene when we have sort of a banking failure, right? Not to even say a crisis, right? So in that sense, sort of we are not going to see, unlikely to see sort of a panic run kind of situation, right? During 2008, many know that Lehman Brothers was at least to some extent driven to failure because of panic run by its creditors, right? In fact, this is the reason argued by Bernanke in his recent Brookings piece, right? But to the extent that the Chinese government are going to be there to heavily intervene, I think sort of it's unlikely we're going to see sort of this kind of panic runs, right? So this sort of with this, that's why sort of it's not my intention here to argue. I should make this clear. It's not my intention to say government intervention is always good, right? In fact, I realize that this is a controversial issue, just like mandating face mask wearing in Western countries, right? Different people have very different reaction to this. Some people think, especially in Asian countries, mandating mask wearing during the pandemic is absolutely necessary and important. But on the other hand, in many Western countries, this is the issue actually regarded as a violation of human rights. And the same thing about government interventions in the financial system, right? So in many countries, this is regarded as necessary, like in China. But on the other hand, in many Western countries, this is regarded as potential intrusion of the free market, right? So I think sort of, but nevertheless, I think it's important for us to recognize there's this very important fundamental difference in terms of philosophy between China and many other countries in managing this the financial system of China versus the other countries.
Wei, just a reminder, okay. Please save some time for Q&A.
Okay,
can you wrap up in just a few minutes, please?
All right, so let me just I'm almost done. Let me just use 2 minutes to wrap up. So here I listed the sort of intensive government intervention here. All this you guys probably know. The government has frequently intervened in all sorts of fronts, right? Suspension of IPO issuance, stamp tax or stock tradings, and so on, right? So with all this intervention, how does this impact the financial system itself? So this is an issue needs a lot of study, which I believe, at least in academia, we haven't paid a lot of attention. Personally, I have done some work on this front. Let me quickly mention this joint paper with Max Brunemeyer, a colleague at Princeton, and Mike Sorkin, a previous student, now at UT Austin. We actually provided the model to analyze how government intervention may affect stock market in China. So government intervention helps to stabilize financial system because unregulated market can be very volatile and might even break down when noise trader risk is sufficiently large. But on the other hand, government intervention can also introduce adverse effect. Active government intervention renders noise in government policy a pricing factor, in fact. And for that reason, intervention can cause investors to speculate on government noise rather than fundamentals, which amplify effects of policy errors on market dynamics. So in that sense, we want to highlight the tension between different objectives, reducing price volatility and improving information efficiency. We often regard these two objectives as equivalent or very similar. But in fact, actually, if you take this seriously, because government intervention can distract the investor from focusing on fundamental. So these two objectives actually can deviate from each other. So this is a very important conceptual issue. The other, let me due to the time, let me skip. So let me just quickly summarize. So China's financial system is quickly growing and still under various reform. It's already second largest by size. But on the other hand, despite all this ongoing reform, I think it's important to recognize the end point of China's reform is not to have another laissez-faire system. In fact, this is a system that can combine market forces with strong government intervention. So because of this sharp difference, I think it's important for us to fully understand how this is going to work and how, especially, I expect China's financial system to gradually integrate into world system. With this different structure in place, how it's going to integrate with the rest of the world. Actually, this different system actually provide many challenges conceptually as well as in terms of policy making and the investment decisions. Yeah, let me end here. Thank you.
Thank you, Wei. There are a lot of very, very meaningful questions. So if I may, let me just give you a few. And also to the panelists, people like Zhiguo et al., when you want to chime in, please do so. Let me ask a few questions on behalf of the audience. The first one is that there seems to be a lot of ongoing and important liberalization and development in the Chinese capital markets. Would you highlight just a few for our for stimulation? Along this line, the question very often is that in the Western world, we are thinking about transparent rules and regulations and let price regulate behavior. But in the Chinese market, quantity interference is there. And also the government objective very often include more than just give me price stability or full employment, but there exists a lot of growth and development and strategic industry allocations and so on. So that's a part of the mandate of many of the regulators. So is there a conflict, and how this will resolve in the future? And do you want to answer them now, or I have some more questions, including
these are very
the RMB
big
introduction?
So can you be a little bit more specific?
Okay, the first one, can you give us a few examples of liberalization that have escaped the people's attention in recent years?
Oh,
what about things like the bankruptcy, the IPOs, and all this thing?
I think so. Clearly, so the bankruptcy is one area, right? So China is trying to. I mean, so except I don't know whose attention. So I'm sure sort of in investment community, people probably know more. Depends on. I think in the general public, yeah, the reform, there's a, the China is trying to put up a sort of a bankruptcy court and experimenting it. So I think sort of getting ready for the default wave to come at some point, right? Because, I mentioned earlier, default rate has been low, maybe artificially low. It can be that low, right? And eventually this has to pick up.
I guess people raise this point because too big to fail is always something in our mind about the efficiency of the system. Then maybe we'll talk about this, the price, quantity, and rules. There seems to be some conflict in your deliberations and so on, and also in the book. The book is really very rich. What is our understanding about how this will evolve in the future? Will the regulators reduce the quantitative the influence in intervention in quantity, and step up more on the improvement of rules and regulations, and let price regulate, let price intermediate?
I think so. You are referring to the monetary policy, right?
Yes. And also like even the regulating the capital market is very often in their mind, and for outside observers,
right? So the price versus the quantity, yes, this is this general issue, right? So I think yes. Sort of this is related to China's dual track reform strategy, right? So this is by far probably the most important strategy, I think. Used by the government in reforming the economy as well as the financial system, right? Often, instead of fully abandon an existing system from the planning years of the government will start a new track, a more market-driven track on the side, parallel to the existing state planning track, right? So with the two track running at the same time, for example, the interest rate reform, right? So while the government, the central bank regulate bank deposit rate in the early years, but there's a bond market on the side. If you buy bond, you can earn much higher interest rate, right? So this and that bond market interest rate is fully driven by the market. So in that sense, sort of these two track coexist, right? And in some extent, sort of to the extent that they have different prices, this can potentially pose the arbitrage possibility, right? And in order to prevent the arbitrage really causing, destabilizing the system itself, so that's why often you have to put on some quantity controls, right? So in that sense, to prevent this kind of cross-market arbitrage or cross-track arbitrage when you have two tracks, right? So that's why sort of we see quantity constraints in many places. Interest rate markets in one place, but we see similar quantity constraints in many other places, right? In that sense, sort of this is necessary, right? So that's why I kind of say that this is very China unique. Because of this nature, I think sort of as reform deepens, I think sort of eventually probably we will only see one track, hopefully, right? So then sort of this two track system probably is a transitional feature, right? But nevertheless, it's important to recognize because of this two-track system that the regulator cannot, the central bank cannot fully rely on price instruments to implement many policy, right? Instead, have to use sometimes even window guidance, right? And in fact, actually, I mentioned earlier, so this so-called macro-prudential policy framework, in fact, actually, it's a more systematic way of doing window guidance, right? Basically, the central bank can now incorporate sort of a different policy objective, which previously implemented by window guidance, into actually a more coherent and more systematic framework to calculate a bank's required capital, and using that to actually tell bank, sort of direct the bank to lend to certain industry or certain borrowers. So in a sense, sort of these are sort of very unique and powerful features. Chinese.
I have some more questions, but let me follow up on this one, just on a quick one. We understand that quantitative track does cause government, give government control. At the same time, it causes inefficiency. From the West side, this quantitative track sometimes is quite bothersome and is inefficient. Would you mind to just help us to understand better why that may not be the case? And will the two track merge into just the traditional price and rule track?
I think sort of, this two track eventually will, as I said, I think I expect many of these two track will eventually converge into one. Right. Mm-hmm. So as the reform deepens, and this is a transitional feature, but the government intervention, not necessarily through imposing constraints, will remain. Right. So government can have many ways to intervene in the market. In fact, government has been very actively using counter-cyclical interventions. Right. Mm-hmm. Increasing interest rate. When market is too hot, regarded too hot, or increase required mortgage down payment ratio when housing market is too hot, right? So this kind of counter-cyclical policy intervention had always been widely used. So that's not necessarily implemented through this kind of quantity controls.
I will ask the audience for your understanding. Allow us to go over time a little bit, because there are a few questions that I think many of you would like to hear answers. Okay. There are three questions I give you all, and so please see what you would like to handle. The first one is about the internationalization of the renminbi, and what has been done, what are the challenges, and related to that, what is the opening up the liberalization of direct investment and foreign investment into China. Second question is that how big is the shadow banking compared to regular? Is a consequence of some of the regulations, and what's the future of this shadow banking thing? And the third question is that people wonder, why would the funds earn more than stock markets?
Say again. The third question?
Why would the funds, the mutual funds, allow people to earn more than the stock market? That's one of the questions. Okay, three questions: internationalization, liberalization in the investment, and also the internationalization of.
Okay, so the second one, how large is the shadow banking? So I think shadow banking, it's very hard to measure. So because all these instruments are, so they actually, typical sort of shadow banking lending activity work through a chain. Several instruments are involved in in order for money to reach from one ultimate saver to the borrower. So, you can go through sort of a bank, and then through a trust, then through sort of another trust. So because of the chain, so measuring sort of the exact size of shadow banking is very difficult because of this kind of a potential double counting. But nevertheless, sort of, the shadow banking system itself now is under control. my understanding, because PBC has already incorporated many of these shadow products into its macroprudential policy framework. And now banks actually have to report all these shadow banking instrument to the regulator. And as a result, these activities had to slow down. And because banks have to pay capital for those, fulfill the necessary capital requirement for those products. And the last one about the mutual fund, why would the mutual fund, I should be more clear when I say that the Chinese mutual fund earn better. It's just relative to the US mutual fund, right? So my understanding is that in China, mutual fund after fee is roughly sort of similar to market. But it's already amazing in the sense that the Chinese mutual fund can, even after taking out a bigger fee, can still be roughly similar to the market, right? So this is the point. I think this is perhaps because China has a large retail investor-based market, right? So there are lots of opportunities for professionals to trade on, and they can actually earn some returns to justify the fees they charge.
Then the question about the internationalization of the renminbi. And also the opening up of China's investment opportunities, including fully owned direct investment in China. Would you mind to comment on that? And if possible, also comment on the impact of the comprehensive agreement on investment in the further liberalization of China's capital markets, please.
Right. So these are very big questions. China has made a great effort in the last decade to internationalize RMB and to further open up current accounts. But it's very challenging because we have seen in 2015 and 16, right? So outflow of over $1 trillion of foreign reserves in the shorter period of time period, roughly 1 year, right? So that was pretty scary. So that's why in recent years, this process has slowed down, even sort of reversed back to some extent. But nevertheless, I think sort of current geopolitical tension, right, between China and the US actually makes it even more pressing for China to further open up capital flow, right? So in fact, actually, we see sort of various effort lately on this, right? So China actually issued full license to various foreign institutions to do banking as well as asset management in China, right? So this is the effort to attract foreign institutions coming to China, and I think sort of. I think actually this will be more attractive than last time. As I said, the current pandemic environment actually made the Chinese economy the bright point around the world, right? So I think we are unlikely to see outflow this time. More likely we'll see inflow.
Hi, Jun.
Hi. Can I ask a question?
Oh, hey, Jun. Hey.
Oh, hi, Wei. I want to direct the question a little bit, maybe sidetracked a little bit our discussion. First of all, I think it's a great conference, a great seminar to kind of put all of us together, all of us working on capital markets in China. I'm looking at your handbook. I think the table of contents is really very interesting. It's very rich. It has all the various components. But I cannot help thinking that 5 years later, probably the contents will be very different because China has just been moving so fast. So, and looking ahead, thinking about 5 or 10 years later, I think the best research probably will be done within Asia, within China and Singapore and Hong Kong, because the young scholars are more in touch with the local economy, in touch with the development. But at the same time, if you ask them how their publication experiences have been, it's probably a tough journey for most of the young scholars doing topics on China. So I'm putting you on the spot since you are the co-editor of the JF. Maybe you could enlighten us a bit in terms of what should they do, or what we can do to foster, to facilitate excellent. I think in China, it's not like when we were graduate schools. I think 5-10 years later, Chinese research probably will be just as important as US research. So how can we foster, how can we help them grow or incentivize them to do more research on China or on Asia, to be more general?
Yeah, I'm totally sympathetic to your comments. In fact, indeed, China's financial system is changing very quickly. That's why we decided it's better to write a handbook so that we can have all these people contribute together. So, if we have to do this again in 5 years, it's not so hard to update it again, right? So I think you are very welcome actually to join the force next time. So even though for now we should take a break. So and also I think sort of more important to your question sort of about the sort of many in the audience are really interested and actually feel the need to work on China's financial system, right? This is very important, of course. This is already second largest in the world. And perhaps, some years down the road, it will be the largest by size, right? So in that sense, sort of, just sheer by size, this importance is self-justified, right? So, and especially, I think when the system is more and more connected and integrated into the world system, I think sort of then I think the global profession will also have to recognize its importance, right? You know what I mean? So in that sense, sort of this is just a matter of time. So in that sense, right? But of course, in the meantime, I think sort of it would be useful for the community to identify a few key questions, right? So to concentrate the force and to work around sort of a few central themes, right? Rather than sort of I treat China as another laboratory for testing Western hypothesis. So I think sort of, you can do, you can write a nice paper about it. In fact, I have done that before myself, right? But at some point, I think sort of we have to get into deeper questions, right? Which actually there are many sort of important and unique features in China's system that motivate questions and conceptual issues, right, on their own right, right? I think so the community will be big enough actually to focus on those issues. And I think eventually, I think sort of the rest of global community will be interested as well, right? I think sort of, as I mentioned sort of during my talk, maybe a little bit briefly, so the fact that actually China has a different system is actually already an important issue for the rest of the world to confront, right? It's not totally clear that this system is inferior, right? So I in some sense, it has its advantages, right? But of course, it has to confront its own challenges, right? Well, so I think sort of this pandemic actually shows that government intervention has its strong intervention has its own advantages, right? Especially in dealing with an environment with lots of externalities.
The reason that we organize this is that we recognize there exists some difference between the East and the West.
Right.
There's
Exactly.
a lot of contextual difference, and also the experience in China. We can cross-check that with the experience in other Asian countries, previously Japan, Korea, and India, and the Asian countries, and Singapore. So what we hope is that we can stimulate people to come together to share the research, and so that we can learn more and stimulate more, and also to allow the West to understand more about what we are doing and why. And if I may, I want to make a suggestion to Songwei and your team in this handbook. I read the book, and you have given us a very comprehensive introduction of the chapters and mentioned some of the contents. I think it would be very useful to think about producing a Reader's Digest. That is not for researchers per se, but for the practitioners, because many of them can appreciate, and also the policymakers can appreciate the vast amount of changes and improvements that has been made over the years. They escape attention, and they escape the fine points that you mentioned in your talk. So maybe a Reader's Digest could be quite useful, and if you like to, we can team up to find some way to handle that. I read the whole book and really am very stimulated by it.
Thank you.
Well, I think I asked for the audience tolerance for us to run over time, and I've run over time by 11 minutes. So I'm going to do two things. One, I'm going to invite my co-organizer, Zhiguo to make some concluding remarks. And before that, I will also invite you to pay attention to the next one, which is on February the 4th by Professor Darryl Duffy, the first one to produce in the West, a course on China's capital market. But this time we expand. Darryl is going to talk about Asia e-currencies and related development and all the pending intellectual puzzles. And so next time will be on e-currency and also more beyond China, but also the whole of Asia. Before I pass the mic to Zhiguo, I want to register my gratefulness to the speaker and all the participants. Zhiguo, please conclude.
Okay, thanks Wei for making the huge contribution to have a great start for us. The purpose is very simple. I like very much of what you organized during the start of COVID, and I thought that's a great story, and I enjoyed there's some monthly. At time it was the weekly, and now we're saying that look, we want to do it long. We try to do it long, many at least a year or more than 1 year, and I really think that one thing that you will see that today is a kind of, we call it distinguished speaker, give us some summaries, give us some overall big picture. I like the Wei's idea of saying it's called enabling government. That's the first time I'm seeing it. I really think that's maybe there's something interesting deep about it.
Common paper.
But I do think, I disagree a little bit about whether it's a so-called government intervention. The government are seeing through, and they try to see what's the best market outcome. And they try to guide it. And a lot of times they're reacting to the market forces. You can give a lot of example of that. Some of the government intervention is anti-market. Some of them is pro. It is in my side is that it's very hard to say which one is actually the positive in the welfare and negative in the welfare. But all I'm trying to say is, later on you will see that we will have Darryl as a second distinguished speaker. But going forward, we will have a Junpang. We'll have the series. I'm not saying you are not serious, but more like seminar style papers, which I enjoy as well, just because in the end, Junpang was saying that we need to build the community academic research. We enjoy the U.S. kind of academic research is really just paper by paper. We know the literature. I feel really that we are just lacking the literature. I feel like maybe Wei Xiang was saying kind of like we need to build up something so that here's a literature, solid background, solid common question, and the people contributed on it. I feel like right now we are not there yet, and hope that this forum will build up for that purpose. So this is all I would like to say, and hopefully we'll see each other in a month. Thank you.
Thank you.
Thank you, everyone.